IBM's third quarter results are out. They beat estimates, raised their forecast, and yet the stock dipped right after. What's going on?
Exactly. It's that classic Wall Street puzzle, isn't it? Good news, weird reaction. So today we're going to unpack those Q3 numbers for you. We'll look at the raised outlook and really pinpoint the operational strengths driving things.
Okay, let's jump right in. The headline numbers looked, well, pretty solid. Adjusted earnings per share, $2.65.
Right, and analysts were only looking for about $2.45, so that's a nice beat.
Yeah, a 15% jump from last year. Pretty significant.
Definitely shows good cost management, good execution on the bottom line.
And revenue.
Also a beat. Came in at $16.3 billion. The estimate was closer to $16.1 billion.
So up 9% year over year on paper, but you always mention that other figure.
Yes, the constant currency number. That was 7% growth.
Okay, maybe quickly explain again for listeners why that 7% constant currency or CC number is often seen as, well, more important than the 9% reported figure.
Sure thing. So constant currency basically pulls out the impact of shifting exchange rates. If the dollar gets stronger or weaker against the euro or yen.
It can make international sales look bigger or smaller than they really are in dollar terms.
Exactly. So that 7% CC growth tells you how much the actual business demand grew volume-wise, operationally. It's a cleaner read on performance.
Got it. So clean operational success, 7% growth, solid earnings beat. Which brings us right back to that paradox. Why did the stock slip late Wednesday?
Yeah, that's the head scratcher. Despite the beat, despite raising guidance, the stock fell.
What's the thinking there? If the fundamentals are strong...
Well, there are a couple of usual suspects. The market might have already priced in a really good quarter, maybe even hoped for more.
So expectations were maybe even higher than the official analyst consensus, whispers of something even bigger.
Could be. Or, simple profit taking. The stock might have run up before the announcement, and some investors just cashed out.
Right, so not necessarily a critique of IBM's actual performance, more market dynamics.
Precisely. And you saw that in the CEO's comments. Arden Krishna basically said, look, the business is strong, the strategy is working, and that's why we're confident enough to raise the full-year outlook. He focused on the fundamentals.
And that forward guidance raise, that really is key, isn't it? They're boosting the outlook for both revenue growth and free cash flow.
That's the signal. Management is saying, this isn't a fluke quarter. We see this momentum continuing.
Okay, so where is this momentum coming from? You said performance improved across the board.
Yeah, that's what the sources point to. It wasn't just one segment carrying the load. Let's break it down. Software first. It's their biggest piece.
Sounds good. Software brought in $7.2 billion in revenue. That's up 9% at constant currency. Where did they see the most action?
The growth drivers were really in those key strategic areas. Automation software, that accelerated really sharply, up 22% year over year.
22%? Wow.
Yeah. And hybrid cloud overall, up a solid 12% CC. Plus, Red Hat, which is sort of the core of their hybrid strategy of bookings, grew around 20%.
Yeah. So the newer high-growth parts are really firing.
They really are. Now, there was a bit of a drag. The older transaction processing business, that was down about 3% CC.
Okay, so maybe that slight weakness in legacy TP spooked some people.
Perhaps. But clearly, the huge growth in automation and hybrid cloud more than made up for it. And importantly, this mix shift is helping profits. The software segment's profit margin expanded by over 270 basis points.
Okay, basis points. Let's translate that quickly. 270 basis points means?
Means 2.7 percentage points. So for every dollar of software revenue, almost 3 cents more dropped to the profit line compared to last year. Shows they're getting more efficient selling higher value stuff.
Excellent. More profitable growth there. Now, infrastructure. This one seemed like a real standout. $3.6 billion revenue, up 15% to CC. That's strong.
Standout is right. This segment had the most, frankly, surprising number in the whole report. IBM Z. The mainframe.
The mainframe. I thought that was supposed to be legacy tech.
You and everyone else. But revenue from IBM Z was up an incredible 59% at constant currency.
59%. Hold on. How is mainframe technology growing like that in 2025? Didn't cloud kill the mainframe?
That's the fascinating part. It seems reports of its death were greatly exaggerated. The sources suggest a couple of things are happening. First, the latest mainframe cycle, the Z17, is apparently hitting a sweet spot. Think about banks, airlines, big retailers. They have core systems that need massive processing power and, crucially, security.
Right. Stuff that can easily just lift and shift to the public cloud, compliance, performance needs.
Exactly. And second, IBM seems to be successfully pitching the Z mainframe, not as an old silo, but as part of a modern hybrid cloud setup.
Ah, integrating it with Red Hat and AI tools.
Precisely. So clients can run their massive, secure transaction systems on the Z, but build new AI-driven applications alongside it, connected via Red Hat OpenShift. It's an and, not an or.
And it's profitable.
Extremely. The infrastructure segment's profit margin expanded by 420 basis points. That's 4.2 percentage points. That Z revenue is high margin.
Wow. Okay, that 59% growth is definitely a story. Let's turn to consulting. That's often a good gauge of, immediate client spending appetite. $5.3 billion revenue.
Yep, $5.3 billion. And it returned to growth, up 2% at constant currency. Not explosive like Z, but importantly, they mentioned sequential improvement. So it's picking up speed quarter over quarter.
And what about AI demand in consulting? We hear so much about it.
It's real. According to IBM, they booked over $1.5 billion in generative AI-specific consulting deals just in Q3.
$1.5 billion in one quarter, just for GenAI projects.
That's what they reported. These are commitments for future work, building AI strategies, implementing solutions. And that high-value work is boosting margins there, too. Consulting profit margin hit 12.9%. That's its highest in 3 years, up 200 basis points, or 2 percentage points.
Okay, so the mainframe resurgence and this tangible AI demand in consulting, they really seem to be driving the overall results. The CEO mentioned a big cumulative number for AI.
He did. Arvind Krishna put the total GenAI book of business, that's software deals, SaaS, plus all that consulting at over $9.5 billion since they started tracking it.
$9.5 billion inception to date. How should we interpret that number? It sounds big, but it's not all new Q3 revenue, right?
That's a really good point. No, it's not Q3 revenue. It's the total value of deals signed related to GenAI over, well, probably the last year or so. It's backlog.
So it represents future revenue streams they've already secured.
Exactly. It shows the pipeline is filling up significantly with AI-related work, which gives them visibility into future growth tied to this huge trend. It's a strong signal of market traction.
And all this segment strength, it's clearly flowing through to the company's overall profitability metrics. Things look healthier there, too.
Oh, definitely. Margins are expanding pretty much everywhere you look. Operating gross profit margin that's non-GAAP hit 58.7%, up 1.2 points.
Okay.
But even more telling, operating pre-tax margin expanded by 2 full percentage points, reaching 18.6%.
2 points at the pre-tax level. For a company IBM size, that's quite a bit of leverage.
It really is. And crucially, this wasn't just a one-off. The report highlighted this is the 9th straight quarter they've expanded that operating pre-tax margin.
9 quarters in a row. That shows consistency.
Yeah, it points to a sustained strategy shifting the portfolio to higher value things like software and Z, plus ongoing cost-cutting or, well, productivity initiatives.
And this feeds into other profit measures.
Right. Adjusted EBITDA, which is a common measure of core operating cash profit, that grew 22% year over year.
22% growth in adjusted EBITDA. Why is that number particularly relevant for listeners trying to gauge the company's health?
Well, EBITDA is kind of a proxy for the cash being generated by the core operations before you count for interest payments, taxes, and wear and tear on assets. So seeing that grow by 22% means the fundamental cash-generating power of the business is accelerating fast, and that cash
Feeds everything else, especially free cash flow. I think the CFO focused on that connection.
He did. James Kavanaugh basically said that consistent focus delivered the strong EBITDA growth, which drove strong free cash flow. And he called that free cash flow the fuel for our investments and ability to return value to shareholders.
Right. Cash is king, especially for funding growth and dividends.
Exactly. Management sees generating cash not just as an outcome, but as the core engine for everything else they want to do.
Which leads us nicely to the updated full-year guidance for 2025. They felt confident enough to raise it. What are the new targets?
Yeah, they nudged things up. Revenue growth for the full year at constant currency is now expected to be more than 5%. Previously, it was just around 5%, I think.
Okay, a bit more optimistic on the top line.
And adjusted EBITDA growth, they raised that expectation too, now targeting the mid-teens for the year.
Mid-teens EBITDA growth. That's strong. And the big one, free cash flow.
That's where they made a pretty clear statement. Full-year free cash flow is now forecast to be about $14 billion.
$14 billion. That's a significant amount of cash generation.
It really is. It underscores the financial strength coming from that operational performance we've been discussing.
And how are they tracking towards that $14 billion goal so far this year?
Pretty well. Year to date, through the first 3 quarters, they generated $7.2 billion in free cash flow. That's up $600 million compared to the same period last year. And they actually noted it represents their highest year-to-date free cash flow margin ever reported. So they're becoming more efficient at turning revenue into cash.
And are they sharing that cash wealth?
Seems so. They mentioned returning $1.6 billion to shareholders through dividends just in the third quarter alone.
Right. Steady dividend payments reinforce that confidence in sustainable cash flow.
Absolutely. It signals they believe they can hit that $14 billion target and keep rewarding shareholders.
Okay, so the key takeaway for you listening to this deep dive, IBM showed really strong operational momentum in Q3. It wasn't just one thing, it was broad-based, but with some, frankly, surprising strength in infrastructure, that massive 59% Z growth and clear traction in AI services. They beat forecasts, they raised their targets for the year. That negative stock reaction seems more like short-term market noise than a verdict on the business itself.
Which leaves us with a really interesting question, doesn't it? You've got this huge 59% growth in IBM, a powerful, trusted, maybe legacy platform. At the same time, they're building this $9.5 billion plus book of business in cutting-edge AI. So does this success suggest the future for big companies isn't about blindly moving everything to one public cloud? Is it actually about mastering the integration, connecting the new AI tools with the reliable, high-performance systems like the mainframe that already run the core business? What do you think is the real lasting driver of value here? Is it the old iron, the new AI, or really skillfully weaving them together?